So I've seen a lot of tax-free savings videos out there that go over the basics, how much you get every year, what the account can be used for, when it started, how to find your contribution room. But I find a lot of these videos miss out on some critical tips that can end up saving you thousands, even tens of thousands of dollars. And we're going to go over 4 of those tips in this video, so let's get started. Quick reminder before we start, head down below, subscribe to the channel, like the video. We appreciate it. We love the support. And it's one way to ensure you don't miss any videos from us. So the first tip we have speaks on contribution room, and it's that you shouldn't take your contribution room lightly, because contribution room can be permanently lost. So the formula to calculate your TFSA contribution room is your old room, which would be anything you have carrying over from previous years, plus your new room, which for 2020 would be $6,000, plus any previous year's withdrawals. So that's your total TFSA contribution room. So say it's your first year of having a TFSA. So 2020 is your first year of eligibility and you have $6,000 to contribute. If you invest in something over the course of 2020 and that investment goes from $6,000 to zero, at the start of 2021, your new contribution amount will be whatever is allocated in 2021. If it was $6,000, you'd only get $6,000. You don't get losses back. So you would think in 2020 you've lost $6,000, so in 2021 maybe you think you'd have $6,000 plus the new contribution room. That isn't true. This is why we don't advocate being overly risky inside of the TFSA. On the other hand, contribution room can be permanently gained. Using the exact same formula, if you hold $100,000 in your TFSA from maximum contributions plus investment gains, and you decide to withdraw $40,000, your contribution room at the start of the next year would be, your old room is obviously zero, your new contribution room in 2020 is $6,000 plus your withdrawals from the previous year to equal $46,000. So you have $46,000 in room even though you've maxed out your contributions over the course of your TFSA. Another very common misconception people have about this rule is the fact that once you pull that money out, you need to contribute it the very next year or else it goes away, and this just isn't true. If you had contributed nothing and withdrew nothing that year, your contribution room the next year would be the following. And as we've looked over before, your contribution room is your old room plus your new room plus the amount you withdrew. So that $46,000 contribution room you had the year before would transfer over to your old room. Your new room would be the contribution limit for that year, which in this case is $6,000, and your total contribution limit moving forward would be $52,000. So as you can see, we've cleared up a few things about this rule because it is very confusing to some people. And if it is still confusing to you, just drop a question in the comments below. I'd be happy to answer any questions you have. So let's move on to our next tip, which speaks about some taxes that a lot of Canadian investors think they're not prone to in the tax-free savings account. So if we were to think of one rule that trips up investors, especially new investors, and could end up costing you, depending on how much you have in there, thousands of dollars, it's withholding taxes. Now, U.S. dividends within a TFSA. U.S. stocks are very important to a diversified strategy. This is clear. We don't suggest not owning U.S. stocks or foreign stocks. However, the dividends within a TFSA are subject to withholding tax. So a common misconception is that U.S. stocks that pay dividends are not subject to this withholding tax inside of a TFSA. But the tax treaty with the U.S. only applies to retirement accounts such as the RRSP, not the TFSA or non-registered accounts. So foreign tax credit, you can forget about it within a TFSA. However, with a non-registered account, say a margin account, you are eligible to claim a tax credit for foreign taxes paid to avoid double taxation. People think that this is usable within the TFSA, but it's not. And the reason being is you're not taxed on earnings in your TFSA. So why would they give you a tax credit to avoid double taxation? So since it's tax-free, you cannot claim tax credits against your investments, and as such, you'll be charged the full 15%. And I'm going to drop a link in the description below that's going to send you to a great article that speaks on withholding taxes, and it's going to show you a bit more detail, as I don't want to get too in depth in this video about that. I want to move on to our next tip, which is the transfer of a tax-free savings account to another institution. So third tip, and this is a tip that burns a lot of investors who just aren't paying attention to the rules, and that is transferring your TFSA. Now, you might be transferring your TFSA to another financial institution. I mean, if you've taken advantage of our Questrade offer, which I'll drop in the description below, maybe you're planning to move your TFSA from a bank to Questrade. The issue is how you go about it, and the important thing is a withdrawal is still a withdrawal in the government's eyes. If you plan on moving your TFSA to another financial institution, withdrawing the funds to execute the move is still deemed a withdrawal. So even if you take it out and it's within another account that very same day, it is still a withdrawal. And as a result, you wouldn't be able to complete the transfer until the next year. So if it's July, you want to move your account to a different institution, you withdraw that money, you won't be able to put it into the new account until January 1st of the next year. You can put it into the new account right away, which is probably what most of you would do if you're unaware of this rule, but you will get burnt. And why is that? That's because over-contribution penalties are very harsh. If you over-contribute to your TFSA, you'll be charged a 1% tax penalty each month. So if you go over by $5,000, you'll be charged $50 a month until you remove the money or until you have new room available. If the new calendar year hits, this would go towards your new contribution room. The 1% monthly fee essentially nullifies most of the returns inside of your TFSA. I mean, they're charging you 12% a year. If you take the average returns of the stock market of around 8 to 10%, you're never really going to be able to get ahead on this penalty. And that's pretty much exactly why they've made it what it is. So if you have $60,000 in your TFSA and you withdraw it to move it to a new institution and you're not paying attention, that 1% penalty, that's $600 a month they're going to charge you. So this is something you really need to execute properly. So let's move on to our fourth and final tip, which is probably the most dangerous thing you can do in the tax-free savings account, and one thing that's going to cost you the most money if you get caught. So the fourth and final tip we're going to go over, and probably the most dangerous one, is trading within your tax-free savings account. Long story short, don't do it. There is a chance you can get burned, and you can get burned very badly. Why? Because day trading inside of your TFSA could be considered a business by the government. And what is the difference between this and, say, selling a stock in your margin account and realizing a capital gain? Well, capital gains are charged at less than your nominal tax rate. But if the government deems you're using your TFSA for business-like transactions, you could be charged 100% of that tax rate. So if the CRA audits your TFSA and deems you've been using the account as a business, you will be subject to tax. In 2017, the CRA collected over $75 million in taxes alone from TFSAs that have been doing this. So if you don't think it happens, it definitely happens. $75 million is a significant amount of money. So what are business transactions? What do they deem to be business transactions? Well, the unfortunate thing is they've never actually delivered any sort of to-the-point guidance, like a certain amount of trades you're allowed to make or a certain amount of transactions you're allowed to make a month. But what they're going to look at if they do audit you is the frequency of the transactions. They're going to look at the duration of the holdings. They're going to look at the history of selling securities for a profit, how often you do it, and they're going to look at the time spent trading inside the TFSA. We don't advocate trading at all, but if you are going to do it, try to do it outside of a registered account, in a margin account where you can take advantage of capital losses. Use your tax-free savings account as a long-term investment vehicle. You're going to benefit so much more in the form of capital appreciation, tax-free dividends. Just don't abuse it, take advantage of it, and prosper with the TFSA. So that's pretty much it for the video. Like I said, if you liked it, head down below, like the video, subscribe to the channel. We do a lot of giveaways for newsletter subscribers and now YouTube subscribers. This can include free memberships to our premium platform over at stocktrades.ca, which is a $200 a year platform. So you're not going to want to miss out on that. Not to mention we offer the best financial content in Canada. So that's all from me. We'll see you next week.